Right. We want to proceed now today and move on to financial analysis of financial information. We are going to move on to analysis of financial information. Last time we were looking at cost of capital. So today we want to look at analysis of financial information. Analysis of financial information. Right. We'll have right. Let me just analysis of financial information. Right. You might find that the reason why financial statements are provided is so that information can be given to users of financial statements so that they can use that information in making decisions. Now you'd find that it's not all people who use the financial statements who are accountants. Some of the people who use the financial statements, they are not even into the field of accounting. You'd find that they are doctors, they are engineers, there are even some who never even went to school. We have got money who invest in businesses. And when they invest in businesses, they need to see the financial statements, but they don't understand the accounting. So we have to find a way of presenting that information to them so that they can be able to make sense of that information. All right. So that's where analysis of financial information comes in. Right. There are many ways in which information can be analyzed. It can be analyzed through what we call, okay, let me just list all the methods so that you can be able to, I think the users, you now know them, that we have got investors, we have got creditors, we have got customers, all those people, they are interested in the financial statements. Right. Then to analyze our financial statements, we've got many ways in which ways of analyzing financial statements. Right. We have got what we call common size statements. Instead of showing our financial statements in amounts, we can show them in figures, in percentages, so that the user can be able to analyze the trends and see the changes that happened over the years. So you find that they are instead of producing them in amounts that is 20,000 and stuff like that, we'll produce them in percentages. The same happens with what we call indexed financial statements. Then we also have what we call ratio analysis. Right. Ratio analysis, which is our major part. Most of our things for this module will be focusing on ratio analysis, whereby we calculate ratios and try to interpret those ratios. We also have what we call trend analysis, whereby we analyze trends, changes over a period of time, let's say 5 years, and see the trend and try to identify trends in the movements of those ratios over the periods that are reported. Right. We have got failure prediction. Right. Then we've got comparative financial statements. Whereby your financial statements are prepared side by side. I think whenever you see financial statements, you'd find the statements for 2022, they'll be prepared side by side with those of last year, so that you can be able to compare and see if the company is progressing or the company is going down. Right. So the aim of all these things is to try to analyze information and get an understanding from the information that we have. So we'll just be trying to make sure that we understand the information that is reported so that we can get more sense rather than to just look at financial statements as they are. So this can help us to get more sense from the financial statements. Right. So now we want to look at some of these methods. Right. As I said, some of the methods I would just ask you to maybe at your own time, for the sake of time, to just look at them maybe from your study guide. I will mainly focus on I will do the ratio analysis. Then after doing the ratio analysis, then maybe next week I might maybe find one question whereby I can just do common size and index. Then the other ones you can just try to get them and then read from your study guides. Right. So now let's look at ratio analysis. So when it comes to ratio analysis, we classify them into different categories. Again, I'll ask you to go and look at this part in your study guide. We have got what we call profitability ratios. Right. These profitability ratios, they measure the profitability of the business. Then we have got what we call liquidity ratios, which measure the ability of the entity to meet its other like its short-term liabilities. Right. Then we have got right. Let me just asset utilization ratios, whereby we look at things like the return on assets. We look at things like the asset turnover and stuff like that. So you'd find that for most of these ratios, you have to know the ratio that measures that particular part. You have to know your ratio. They normally ask you to know the ratio. After knowing the ratio, you have to know what it means. Right. So we want to use the question papers that I sent to you to see how do we do the ratios. So please, you have to know that at this level, they will ask you for the formula. What is the formula that you use to calculate? They can ask you, what does the ratio mean? Then you should also know how to interpret whether there's an increase or a decrease and whether it's the meaning of that change. Is that right? Right, so I will open the paper that we are using. Right. I would start with the May-June 2022 paper. The May-June 2022 paper. Right. We'll be dealing with question 3. question 3. So we'll be dealing with question 3. Right. The following two financial statements of Wickwalk Limited are presented to you. We have the statement of profit or loss and other comprehensive income. We have the statement of financial position. Right. Then we are told that then there's additional information. You can just also read it because it might help you whilst answering some parts of the question. Wickwalk Limited has 4 million authorized shares. They've issued 2 million ordinary shares. No fixed assets were sold or traded during the year. Credit sales were 95% of revenue for both years. The dividend per share is 8 cents. 2020 is 5 cents. Assume a 360-day year. 30 days, assume a 360-day year, 30 days per month. Value added tax is calculated at 15%. Right. Now, on our question, calculate the following ratios from A to E below for Wickwalk Limited for both years 2021 and 2020. Right, we've got gross profit margin. Gross profit margin is the profit from trading. So they want 4 things. You have to show the formula and detailed calculation. Right, and you should know that, do they want for 1 year or for both years? Here they want for both 2021 and 2022. Right, so they want the formula. Then they also want give a description or what it indicates. So that means, what is that gross profit margin that we're talking about? Right, then indicate whether it is increased or decreased. So it's just a question of to just check whether the ratio is increased or decreased. Right, then give a possible reason for the change. Right, so I want us to go through that. Okay, so say A, gross profit margin. Right. Let me just open the paper also somewhere so that I can be able to be accessing it. Right. So Jeff, number 1, the formula and calculation. Right, our formula for calculating the gross profit margin is gross profit over sales. Gross profit over sales. So it will be gross profit multiplied by 100 over your sales. Right. So then we want to calculate for 2022 and 2021. Right, so you can get your, if you see here, you know that we get this from the profit or loss. This is the revenue. Revenue is the sales. Then the gross profit is this one. So you just take your gross profit, your 2.4, then you divide by the 7.2. Then that will be your gross profit margin for 2021. And then for 2020, you do the same, your 1.5 divided by 3,000. So that's 2021 and 2020. I have to correct my years there. So I would say for 2021, we are going to say That's 2.4. $7,200. What do you get? What do you get?
$33.33.
33.33%. They normally say you should put to 2 decimal places. Right, we'll just check also here. Then we've got 1,500 multiplied by 100 divided by 3,000. This one, I think, is definite. That is 50%. 50%. Right. So we have answered the first part that says formula and calculation. Then the second part, it says give a description of what this formula indicates. Right. So we can have number 2, the gross profit margin indicates the proportion of sales available to cover the expenses. After covering cost of sales. So that means 33% of the sales are available to cover other expenses. That's what it means when it say our gross profit margin is 33.33%. That means 33% of the revenue would then be there to cover other expenses. Right, then number 3, it says indicate whether it is increased or decreased. Right, so we have now, as we can see, it decreased from 50% to 33%. So we can say the gross profit margin deteriorated from 50% in 2020 to 33.33%. Right. So you have stated whether it is improved or reduced. Give a possible reason. Right. There are many reasons why our gross profit margin can increase or reduce. Right. Right. There can be decreases in selling prices. Due to competition. Increased discounts given to customers. You can reduce your gross profit margin. Increases in supplier prices. Right. You should not just talk about the change in quantity, because as long as the prices did not change, your gross profit margin will remain the same regardless of the quantity that you sell or buy. So as long as the price of your supplier and your price have not changed, the quantity does not affect the gross profit percentage. It affects the gross profit amount, but not the gross profit percentage. Whether you sell a million or one item, as long as the purchase price is the same and the selling price are the same, the gross profit margin will not be affected. So when you are arguing about the reasons for a gross profit margin, don't talk about the quantity unless if you are linking it to the price. For example, you can say that there were many customers who were purchasing in bulk. Because they were purchasing in bulk, they were then qualifying for a trade discount. Then it can make sense. But don't just say the quantities that were sold increased or decreased. So you can use any of those reasons. You can talk about inflation that increased supplier prices, but in turn, the company did not increase prices. Due to market circumstances. Right. It can happen that your supplier, their competition is not all that tight. Maybe all of you are buying from one supplier, but there are many people buying from the supplier. So what will happen at the end of the day is that he can increase the price, your supplier, but you, because of your own competition, you can't do the same. So at the end of the day, you just keep your prices at their level. Right. So this is how we answer this question. So do we have any questions, especially on how we answer such a question? So this topic is not very difficult as long as you know your formula. But of course, expect also to be answered, to be asked about the possible reasons and the meaning of the ratios. Right. So let's look at the next one, the current ratio. Current ratio. The current ratio measures the ability of the entity to pay its short-term debts using its short-term resources. So it's actually the ability of the entity to satisfy or meet its short-term debts using its short-term resources. Right. First of all, they want us to show the formula and the detailed calculation. Right. Our formula and calculation. Our formula is current assets over current liabilities. Right. So here we can have current assets. You take these totals here. Total current assets. Then whatever we have there, then you divide by the total current liabilities. So they will be given. Right. So we can say (2021), then 2020. Right. In 2021, right, our current assets are 3180. In 2020, they are 2440. Then our liabilities in 2021, they are 2800. In 2022, they are 960. What do we get?
1.14 for the first one.
1.14.
Yes. And the second one is 2.54.
Okay, you can just leave it as 2.54, or you can just put it as I did there to say 1.14 as to 1. The meaning of that is for every one rand of liabilities, we've got 1 rand 14 cents available of assets to cover for that. Actually, they say that if the current ratio is more than 1, then you are safe. You can be able to meet your liabilities. Right. Give a description of the explanation of what the current ratio indicates. Right, so that's number 2. Right. It measures the ability of the entity to meet its short-term debts using short-term resources, short-term or immediately available resources. So that means if your ratio is less than 1, that means you might not be able to meet your short-term needs. Right. Then the next thing is indicate whether it is increased or decreased. Right. The current ratio decreased from 2020 to 2021 from 2.54 to 1.14. Right. Then they also want you to determine, to give a possible reason. Normally, to get your possible reason, you can check if there were decreases in current assets. If you can see there was a significant decrease in inventory from 2600 to 1580. There was an increase, not a decrease, sorry. So we can't use that one. So maybe let's see. We can't use that because we want to argue about a decrease. I think it's this one here, the payables, which moved from 420 to 1800. So we can say there was an increase in payables from 420 1,800,000. Right. So this might be due to the high cost of other forms of debt. which leads to the organization mainly using trade payables as the major source of short-term finance. So if you see that other short-term sources are like short-term loans, bank overdrafts, they are more expensive, you can turn to trade payables, whereby you start paying them as late as possible. If they give you 60 days, you pay around 58, 59 days, because you know that it is cheaper compared to other sources of finance. So you can just look at you can also use the items that make up the formula to argue the reasons for the movement. So I knew that my current ratio is current assets over current liabilities. So if it changes, I have to go on the what? On the current assets, right? If you saw, I ignored the inventory. The inventory actually increased from 1580 to 2600. But if you are talking about an increase in inventory, it actually increases the current ratio. So it doesn't support our outcome at the moment. So that's why it's not very important. But you can also talk about maybe a huge increase in inventories that were supported by trade payables. That can make sense as long as you are linking it to a decrease in the current ratio. Right? Any questions on the current ratio? Right. Then we go to the next ratio. Right. The next one is the receivable days. Now our receivable days, it measures the number of days that it is taking for us to get back our money from our customers after selling to them on credit. Receivable days, that means the days it is taking for our customers. That is, if we sell to them today, how long are they taking to pay us? So it's the number of days that our customers are taking to pay us from the date that we sell to them on credit. That's the trade receivables period. Right. Receivables days. Right. I'm going to say trade receivables times the days in a year. So you should check your question. If they don't give you a guideline, you use 365. But in this case, they told us that we should use what? 360. So we use 360. So please always check first before you apply your formulas. So multiply by 360 over credit sales. Right. Another thing that we have to know, normally in our financial statements, our credit sales is excluding VAT, but the trade receivables include VAT. So it is unfair for us to use one figure including VAT whilst the other is excluding VAT. So when we are calculating this formula, unless if we are told that the business is not a VAT vendor, we should make sure that we account for the VAT by adjusting the sales for the VAT. Especially if they tell you about the VAT is 15%, so we have to take into account the VAT. Right, so and we should know that our sales is not always that all of them are on credit. We have to check what percentage of sales is on credit. Sometimes they tell you, now we're told that credit sales are 95% of revenue. So we're only going to take 95% of revenue. Right, so our receivables, we get them on the current assets. These are our receivables here. 580 and 560. So we have 2021, 2020. Right, we have 580, 560. Over the credit sales. Which is this, but remember we have to adjust them for VAT. So to adjust them for VAT, we would say 7,200 times 1.15 to include VAT in the revenue. So always, if they talk about VAT, unless if they say the business is not a registered VAT vendor, then you don't have to adjust it for VAT. So we always do this for the trade receivables days and the payable days. Always adjust the bottom part for VAT. Right, what do we get?
$33.35
days. These are days. In the other one,
the other one it says 77,28.
so that is the calculation and the formula. Then they said we should on number 2, we should give a brief description of what a net profit margin indicates. So please, you should be very careful there. Although they are asking about the trade receivables days, but on the second part they didn't ask about the trade receivables days. They're asking about the net profit margin. Is that right? But I would suspect that this was a mistake. So instead, I will just talk about the receivables. Like in this question, I would suspect that there's no reason that they can ask about the net profit margin on the receivables days. So I would assume, for the sake of the exercise for today, I would assume that this is a mistake. Then we'll talk about the receivables days. So, okay, so that means this ratio indicates the average number of days it takes the credit sales to be converted into cash, or the number of days that it takes our credit customers to pay us. Right. Then number 3, indicate whether it is increased or decreased. The receivables days have reduced from 37.28 days in 2020 to 33.35 days in 2021.
Sorry, Eugene.
Yes.
Yeah, I think this 2020 says is 77.28.
For which
Not
year?
37.
This one.
Yes.
Thank you. Right. Then give a possible reason. Right. If you can see, there's been a great improvement in the number of days that we are taking. So actually, maybe let me just say that they've improved. When the trade receivables days go down, it's actually an improvement. Right. It's actually an improvement. Right. So we're going to say maybe there was an improvement in debt collection policies. For example, vetting of credit customers, follow up on debts from customers. So maybe that all those things were there was an improvement in terms of that. Right. Then we can also talk about offering of discounts. Which encourage customers to pay early. Sometimes businesses can offer discounts, which can make their customers pay early. Right. Then number D, we've got the return on assets. Right. Sina is saying that they are getting 25.22 for 2021 and 58.43 for 2020 in terms of receivable days. Can someone maybe confirm for us what are the receivable days? Which ones are the correct ones? Can you please verify, my friends? Are they correct? The 25.22 and 58.43. Can you verify, please, guys? so that we can move forward. My friends, can we verify if this one is correct? Someone is saying it's wrong. Just tell me
Yeah,
if
we're
it's
trying
correct.
to do that, Eugene.
Okay. Sorry about that.
Okay.
Only the 7,200 and 3,000 are multiplied by 1.15, right?
Yes.
Yeah, okay.
Oh, so the are you saying the 25.22 is the correct?
Yes, because I get that when I do what you did there, but I get the other answer if 580 times 360 divided by 7.2, and then the answer you multiply by 1.15.
No, that would be wrong. Because
Yeah,
the
no, okay.
1.15 is only multiplying the 7.2 only.
Cool.
Okay, thank you. So thank you guys. So I will correct here. But still it remains an improvement. Right. Now with the return on assets.
Okay, sorry. Hello?
Yes.
Okay, now I'm confused. Can you please explain this one? Because I was getting the other one, but now.
No, my friend, the mistake that you are doing is you're multiplying the 1.5 with everything. The 1.5, it's only multiplying the bottom part. So the best way when you divide, just put brackets here. Because if you just say 580 times 360 divided by 7.2 times 1.15, you'll be making the whole formula multiplied by 1.15, but it's only the bottom part that is multiplying by 1.15. So on your calculator, maybe can you use brackets at the bottom there?
Okay.
Confirm if you are sorted. Just confirm when it's
Yeah, I'm sorted. Thank you.
okay. Thank you so much.
Okay.
Right. So the return on assets to calculate it, we say our EBIT multiplied by 100. When we say EBIT, it's earnings before interest and tax. That is your profit before interest and tax. Profit before subtracting interest and tax over the revenue. That's our formula. Right. So we'll have what did I say? I think I put something wrong here. This is over total assets, sorry. Right, our EBIT, here it is 1560 and 750. Then our total assets, yeah, What do we get?
22,22 and for 2021 and 2020 17,28.
Right. So those will be our return on assets.
2,2, not 3,2.
Okay, thank you, sir. The next part, it says a brief description of what this profit indicates, this ratio indicates. Right. Right. This ratio measures the performance or profitability generated from utilization of the assets. Right. Then indicates whether it has increased or decreased. So the ratio increased from 17.28% in 2020 to 22.22% in 2021. Give a possible reason. More control on usage of assets. Better production methods. Training of employees. Improved maintenance of assets. When you maintain your assets, they can become more productive. These are not all. These are just some of the reasons that can result in an improvement in the assets ratio. Right. Then the next part. Okay, that's it. Then our last question on this question paper is the dividend payout. Right. When you're calculating your dividend payout ratio, it actually indicates the proportion of profits that you are going to pay out as dividend. Dividend per share times 100 over earnings per share. You can even use total. You can say your total dividends over the total earnings. You still get the same answer. Right now in this question, The net profit, the 760 and the 360, those are our earnings. Those are the earnings. So we need to know the dividends. Here is the dividend per share. The earnings, we know them in total. The earnings is the profit, which is 760 and 360,000. But we know the number of shares. The number of shares, they've got 2 million issued ordinary shares. So we can say right, we would say (2020) right, to get our dividend per share, it's given. But we just have to convert it to cents, to rands. It's what? 8 cents for this year and 5 cents for last year. So we can just say 0.08 times 100. 0.05 times 100. I just converted my 8 cents and my 5 cents to rands. Then our earnings, right. Our earnings will then take the profit that we have, then we divide by the number of shares, which is 2 million. Like here, we know that our earnings are 760 and 360, then we divide by that 2 million. Right. So we're going to say we divide by 760,000. Make sure that you use brackets, my friends. So we're dividing by 2 million so that we can be able to find how much is it per share. We do the same on the other year. That's 360. What do you get? $27.78. Oh, but that's 2020. Then 2021. $21.05. Right. Then the next question is a description. Is the same thing. Right. Our dividend payout represents the proportion of the profits that has been distributed as dividends. For the year distributed to shareholders. As dividends. Then we know that our ratio decreased from 2020 to 2021. Possible reasons. The need to retain more profits for future expansion. When an entity requires to save profits for future expansion, they will distribute less profits. Then you can also talk about cash flow issues. They might have maybe wanted to avoid a huge cash flow resulting from the payments of dividends. So to do that, they can just reduce the dividends that they have to pay. So those are some of the reasons why you can reduce, or you can just be a change in the dividend policy. Any questions there? All right, if you don't have any questions, my friends, can you also do question on the other paper that I sent? Can you do question? I intended to do both of them today, but because of the delays that happened, can you do question 3? You will not be doing all of it. I want you to just do the part of the ratios. Do question 3, then you do the ratios on question 3. Then when we meet, I will also talk about the indexed and common size statements. Do you have any questions?
Sorry, Eugene. Is this 2 million issued
The
for
number of shares.
On the number,
The
of,
number
shares.
of shares. Yes.
Yeah. But for
The 2 million is the number of shares. We're trying to find how much is remember that we said